Hello, this is Chuck Carnevale. I'm the Chuck in the Markets Up Chuck, and today's blog was titled "Value versus Volatility," and the issue here is that if you look at stock price volatility, one thing that I think investors often overlook or forget to think about or just simply don't consider is that not all price movements are the same. For example, not all price drops are the same, nor are all price rises the same. And I'm going to use the example of some financials here just to make the case, because last year obviously went through this financial debacle, and you had names like Bank of America. I want you to notice that Bank of America, this is a 20-year chart I'm showing, or a chart that goes back to 1991 actually. I want you to notice that Bank of America had very consistent earnings growth, and their stock price generally followed that, and there were periods where it got overpriced. Now this was a big stock price rise that really was unjustified, I might add, and so it eventually came back to value. But then we had this period where the stock price rose. But the point I want to make is during the debacle, Bank of America was involved in some of these toxic paper issues and so on. So their earnings collapsed. Their earnings went from $3.41 or actually $4.17 at their peak, and dropped all the way to like a quarter a share. And you saw the stock price fall from the 50s and get all the way down to under $3 a share, as you can see by the high and low in 2009. And it has recovered some now based off of just, I think, speculators. But the reality of it is this is a price drop that should have happened. Bank of America actually did have a real issue with their fundamentals. In other words, their earnings collapsed, and therefore the stock price was following deteriorating fundamentals. If you look at another bank that wasn't involved in any TARP or anything else called Hudson City Bank Corp., you've got a company that had tremendous growth, no debt on the balance sheet. Earnings growth has been 19.5%. You can see that the company grew extremely well, and even right through the recession, since they didn't participate, they actually do business, banking business the old-fashioned way, and they've often been called one of the best. Forbes actually called them the best managed thrift in the country. Their stock price dropped also, but my point is that it really shouldn't have, because there was nothing bad that was happening to the company's fundamentals. The company's fundamentals actually not only held up well, but actually even accelerated somewhat in the recession. So here was a case where the fundamentals really didn't make any sense. If I look at a couple of insurance companies, for example, I can look at MetLife, which is, by the way, a pretty quality insurance company, very well run, and I've got an 11-year chart here because it's only been public for a while as an independent company. Had good earnings growth, and stock price followed that. But then what happened in the recession? They did have a big drop in earnings. As you can see, earnings fell by 14.7 and 39%. Now I'm going to run an equivalent chart for the same time frame with Aflac, which is obviously the duck. It's obviously a very well-known company. The difference between MetLife and the stock drop on MetLife was Aflac had very consistent earnings. I want you to notice their earnings continued to advance. In fact, 2008 was one of their best years ever, with over a 19% growth rate in earnings, and they're expected to grow by over 20% this year. So what happened to Aflac is their stock price fell and got all the way down to under $11 a share, and it's rallied back to $45 a share because, in my opinion at least, this was a totally unjustified stock price. On the other hand, if you go back and look at MetLife, what happened to MetLife is their stock price went from $70 a share down to $11 also. It's only recovered back to $34, which is a nice recovery, and it's coming back in line with earnings. But the main point is, here the stock price was actually following earnings. In the case of Aflac, it wasn't. In the case of Aflac, that was an unjustified drop in value, in my opinion at least, based on the fact that their fundamentals stayed intact. So it's important to realize the difference between just pure volatility and value. And in my view, this created an enormous opportunity in Aflac, where if you look at Bank of America or some of the other companies that had these big collapses in earnings, those weren't as much opportunities as they were justified stock drops. Hope this gave you some more insight into the investing process. It's Chuck Carnevale saying thanks for listening. It's Friday. It'll be off as usual for the weekend, but we'll talk to you again on Monday. Y'all have a great weekend. Thanks for listening.